Hello and welcome. My name is Steve Menenti and I'm an attorney with Schwartz & Associates. I have with me my colleague Georgette King, our operations and IT specialist. Today we'll be providing an overview of the new TILA-RESPA integrated mortgage disclosure rules that will go into effect this summer. This is quite a monumental change to how mortgage disclosures currently work, and today we hope to give you a comprehensive overview of what these changes will entail. The agenda for today. We will start with background information about how the new rules and the new forms came to be. We will discuss the integrated disclosure rule itself, such as its purpose, its applicability to certain transactions, and the exceptions to it. Next, we will go over each page of the new disclosure forms, pointing out differences between the new and the old forms, and will help familiarize you with both the layout and the content of each form. Then we will go over some of the key definitions from the rule that must be understood moving forward. And finally, we will wrap up with important takeaway points about how these new rules and forms will impact your business and mortgage transactions in just a few short months. We begin with the Dodd-Frank Act. In 2010, Congress passed the Dodd-Frank Act in response to the 2008 financial crisis. Dodd-Frank ushered in broad, sweeping financial regulatory reform. A critical component of Dodd-Frank was the establishment of a new federal agency called the Consumer Financial Protection Bureau, or the CFPB. At its most basic level, the CFPB's mission is to protect consumers by carrying out federal consumer financial laws. The CFPB is now responsible for all matters related to consumer protection in the financial sector. It has jurisdiction over banks, credit unions, securities firms, payday lenders, mortgage servicing operations, as well as many other financial institutions. To accomplish its mission of consumer protection, Congress put the CFPB in charge of the Real Estate Settlement Procedures Act of 1974, RESPA, and the Truth in Lending Act, TILA. Previously, these two laws were under the purview of two separate federal agencies. The Department of Housing and Urban Development administered RESPA, and the Federal Reserve Board was responsible for TILA. RESPA and TILA are best thought of as two complex statutes that were created independent of one another and do not necessarily work together well. RESPA is a dual-purpose statute. It is an anti-kickback and a consumer disclosure statute. The consumer disclosure portion of the statute is intended to help buyers and sellers understand how much a particular transaction will cost them. The current RESPA disclosure forms are the good faith estimate and the HUD-1. TILA is a lending statute that covers proper disclosure of things like the use of credit, the cost of credit, and projected payments. It is intended to show a consumer how much it will cost to get a loan and requires the disclosure of things like the annual percentage rate and projected payments. The initial TIL and the final TIL are the current TILA disclosure forms. So, we have these two disclosure statutes, RESPA and TILA. The two have some similarities and their own set of initial and final disclosure documents, but also have many inconsistencies and overlapping parts, and from their inception, never were very cohesive or complementary. Prior to Dodd-Frank, back in 1996, Congress proposed integrating the four mortgage disclosure forms into two in an attempt to try and get RESPA and TILA to meld together better. This plan ultimately failed, as HUD and the Federal Reserve Board were unable to work together effectively. Enter Dodd-Frank, which, in addition to creating the CFPB, mandated that the CFPB combine the four current disclosure forms into two new forms. To accomplish this, the CFPB interviewed consumers, lenders, and other stakeholders. They showed them drafts of the new forms, and they ran focus groups. A lot of time, money, and resources were spent developing the new forms. And on July 9th, 2012, the CFP proposed new disclosure rules and a new set of disclosure forms. The CFPB opened up these new rules and forms to a comment period and invited anyone and everyone to weigh in on what they had created. Over 37,000 comments were received from the public critiquing the proposed forms and rules. The CFP then revised the proposed rules, and on November 20th, 2013, after many changes and edits, the final rule was issued and became law. Currently, we're in the implementation period, and when that is over, the law will go into effect on August 1st, 2015. It appears this date is set in stone and is unlikely to be pushed back. Some proposed changes were not implemented, such as the all-in APR, which would have added additional costs, such as title insurance, to the finance charge disclosed. Additionally, the CFPB initially proposed that all documents must be machine readable with barcode or some other similar technology. This would have been a huge change for the industry and would have increased the already high IT and software costs of implementing the new rule. So why did Congress and the CFPB spend all this time and money on these new forms? Well, the CFPB believes the new disclosure forms will be easier to use and will improve consumer understanding of key loan terms and features, such as the short-term and long-term costs associated with the loan, as well as the risk factors associated with the loan. The CFPB also believes the new forms will make it easier for consumers to comparison shop between different lenders and will allow them to shop for the best deal on closing costs. Finally, the new forms are intended to help avoid surprises at the closing table by imposing stricter limits on closing cost increases and by giving the consumer more time to review and consider the loan. The names of the two new forms are the loan estimate and the closing disclosure. You can say goodbye to the GFE, TIL, and the HUD-1. Get used to these new names now, because we'll be using them in August of this year. So, when do we use these new forms? What are the requirements? Is the mortgage application date on or after August 1st? Is the transaction a closed-end mortgage of a 1 to 4 family dwelling attached to real property? And finally, do you make more than 5 mortgage loans per year? If yes to all three, then you will use the loan estimate and closing disclosure. This is pretty straightforward. These are the transaction types that do not use the loan estimate or closing disclosure. And to be clear, it isn't that you just are not required to use the new forms on these transactions, it's that you cannot use the new disclosures and must continue using the old disclosure forms. The exceptions include home equity lines of credit, reverse mortgages, mobile home loans not attached to real property, certain housing assistance programs, and finally, if you make 5 or fewer mortgage loans per year. So, there are quite a few exceptions, and if you're doing any of these loan types or are making 5 or fewer mortgages a year, then you will still use the old forms, the initial TIL, GFE, HUD-1, and final TIL. If you'll be involved in any of these transaction types, you'll need systems in place to generate both the old forms and the new forms, which is quite a costly technological burden for many smaller lenders. Now, I'm going to turn it over to Georgette, who will give you all a nice overview of the forms themselves. Georgette?
Thanks, Steve. Now we're going to get into the good stuff, the forms themselves. Let's start with the loan estimate. This is the document that will replace the current good faith estimate and the initial truth in lending disclosure. It's 3 pages long, just like our current GFE, and it must be provided to the consumer within 3 business days of application. Now, that sounds like a pretty straightforward statement, but we're going to get into the definition of application and business day shortly. There have been some changes to those terms in the regulation. The loan estimate should be a good faith estimate of the closing cost and transaction terms for this loan provided to the consumer. The reason for that is so that the consumer is allowed to shop around and decide if this loan is right for him or her. And then last on this slide, the loan cannot close until 7 business days have elapsed since the delivery of the initial loan estimate. Again, we'll talk about business day definition here in just a few minutes, but they're given this 7-day waiting period so that they have time to evaluate the loan and make sure it's the right loan for them. Okay, let's look at page 1 of our loan estimate. At the very top, you'll see general information, then loan terms, projected payments. That section is going to reflect a payment stream just like you would see on your initial truth in lending. And at the bottom is a cost at closing table. This table is going to show the borrower approximately how much cash they'll be required to bring to the closing table. But I'd like to get more in depth about some of the formatting requirements from the CFPB. These forms are dynamic. They can change for every transaction depending on the loan purpose and product. There are some sections on the form that will not appear if they don't apply. For example, here on page 1, we can see the projected payments table. There are 4 columns reflected. If this were a fixed rate loan with no PMI, you might only see 1 column. You can only reflect the number of columns that apply to the loan. They can't be left blank if they don't apply. If the loan amount and interest rate are whole dollars or percents, the amounts reflected are truncated at the decimal point. Under can this amount increase after closing, and does the loan have these features? Yes/no answers must be reflected in capital letters and in bold font. Bullet point answers to yes questions are reflected to the right. Sections of those answers are also in bold font for emphasis. The answers must reflect when changes will be made, as well as maximum amounts and percentages that may apply. Also, the headers for each section have very specific requirements in their formatting. You'll see that the headers for loan terms, projected payments, and cash to close tables have rounded corners. They must also have a black background with white lettering. As we move on to page 2 of the loan estimate, we're going to talk again about a few of those formatting items, but I just want to briefly look at the page and show you what's on it. It's an estimated itemization of the fees that will be charged for this transaction. Remember on our GFE we had lump sum totals for each section. The loan estimate will now itemize each fee in their appropriate section. We have origination charges, services borrower can and cannot shop for, taxes and other government fees, prepaids, initial escrow items, and an other section. And then those are totaled up. You can also reflect a lender credit there under section J. There's a calculating cash at closing table, which is going to basically add up all of the charges for the loan to get an estimated cash to close amount for the borrower. And then at the very bottom, we have adjustable payment and adjustable interest rate tables. We go back to the forms being dynamic. These tables are only allowed to be shown on the form if the feature related to that table applies to our loan. So our sample here was an interest only for 5 years and an adjustable rate loan. So both of these tables actually apply. You may see one or both of them or none of them on your form. I want to talk now a little bit more about some of the formatting items that the CFPB has specified. The fees under each section must be alphabetized. So you'll see under services you can shop for, we have appraisal, credit report, flood. Those are all alphabetized. Each fee reflected is rounded to the nearest whole dollar. So you'll only see whole dollars on this page, and they're truncated at the decimal point. The CFPB specifies the number of lines and fees that can be reflected in each section. Section A and Section B are limited to 13 lines, so if you have more than that, then there are specific requirements as to how those additional fees are reflected. Any fee related to a title service or closing is preceded by the word title with a dash. And you'll see that under Section C, under services you can shop for. And then if you look over under Section H, under other, you'll see title, owner's title policy with the word optional. The CFPB requires that that tag for optional be reflected if the borrower has the option to purchase that fee and it's not a required fee to close the loan. So again, we have very specific requirements as to the formatting of this form. Now let's talk about page 3 of the loan estimate. At the very top, you'll see contact information for your lender and your loan officer. The next is a comparison section. It spells out the annual percentage rate that we would see on the loan estimate now, the amount that the borrower will have paid in the first 5 years of the loan, and then a total interest percentage. This is a new line that the CFPB has added. You'll see on this sample that it's 81.18%. This percentage is the total amount of interest that the borrower will have paid over the loan term as a percentage of their loan amount. I have a feeling that this section is going to generate a lot of questions from your borrowers. The way that this figure is calculated is you take the dollar amount of the interest that they will pay over the entire life of the loan and divide that by your loan amount. So you'll have that calculation available if someone were to ever ask you where it comes from. Down at the bottom, you'll see other considerations. Those are some general statements. We have an appraisal statement, an assumption as to whether or not the loan is assumable, homeowner's insurance, that it is required on the loan and that the borrower has the right to choose their own provider, late payments, a refinance statement, as well as a servicing statement. The last section down at the very bottom is just a confirmation statement that the borrowers can sign confirming receipt of the loan estimate. We've covered the loan estimate. Now let's talk about a few alterations that are allowed to the loan estimate for transactions without a seller. The page 1 cost at closing table that we saw on the loan estimate just a moment ago can be replaced with the alternate table we see down here at the bottom. Basically, there's a few minor differences. Down here at the very bottom, it shows the estimated cash and whether or not it will go to or from the borrower. The next permitted alteration for transactions without a seller would be on page 2. The calculating cash to close table that we saw on our purchase transaction could be replaced with the alternate one that's reflected down here on the bottom right corner of this page. Something to note here though, if you use the alternate version of the cost at closing table that we saw on the previous slide, you must also use the alternate version of the calculating cash to close table that we see here. Let's move on now and talk about our closing disclosure. Our closing disclosure is going to be the one that replaces our HUD 1 settlement statement that we use at closing now, as well as the final truth in lending. It's 5 pages long, and it must contain the actual final cost in terms of the loan. Remember, the loan estimate is just that. It's an estimate of the cost, so the closing disclosure will reflect the final cost for the loan, and it must be provided to the consumer no later than 3 business days prior to consummation. Here is page 1 of our closing disclosure. Essentially, it's the same first page that we saw with the loan estimate. It has the same information, general information, loan terms, projected payments, and our cost at closing table. Nothing new here. It's the same dynamic form with the same requirements. So we're going to move on to page 2. The formatting for page 2 of our closing disclosure is different from what we saw on our loan estimate. You'll see now that you have the ability to indicate who the fee will be paid by. Remember, on our HUD 1 settlement statement, we indicated everything in the borrower column and then just did credits on the front depending on who was actually paying them. So you can actually itemize the fees now in the borrower column, seller column, or paid by others. If you have a split fee, you would just show them in the separate columns, split the fee out however you need to do so. The fees on here are still alphabetized, just like we saw on our loan estimate. We still have the requirement to reflect title fees with the word title and a dash in front of them. We can reflect optional like we do down here under the other section for our owner's title insurance, because that's not required by the lender. The fees on page 2 are the actual cost of the loan, so you will reflect dollars and cents. Remember, on the loan estimate, those figures are rounded to the nearest whole dollar, so this figure will actually include dollars and cents. And down at the very bottom, you will see there's also a section for lender credits. So it's a little bit different in the formatting that we're used to from the HUD, but I think it's going to be a good change in that now you can actually see who's paying for each fee on this page. Now we're moving on to page 3 of the closing disclosure. At the very top of page 3, you'll see our calculating cash to close table. We saw one of these on page 2 of our loan estimate. And you'll see a loan estimate column here, and those figures just transfer over. So now we're going to do a comparison with our final figures that we're collecting. And again, we have a column asking, did this figure change? We have to disclose to the borrower yes or no with a simple statement as to where they can find where the information changed within the document. And then under that section, you'll see summaries of transactions. This is very similar to what we see now on page 1 of our HUD settlement statement. It's just a summary of the borrower's and the seller's cost associated with this loan. Here we have page 4 of the closing disclosure. Again, we have some loan disclosure information regarding assumptions, demand features. Again, our late payment statement. Does our loan have negative amortization features? And will your lender accept partial payments when you make the payments on your loan? Over in the right column, we have information related to our escrow account. At the very top, if you have an escrow account, you'll have information related to the figures associated with that escrow account. And then the bottom portion of that section indicates that the loan will not have an escrow account and why. And then again, it will have an estimate of cost over the first year of the loan related to those escrow items. Even though they're not being escrowed, they want to show the borrower what the estimated cost will be to them. And finally, we have page 5 of the closing disclosure. Let's start here in the upper left corner, the loan calculation section. Most of these figures are not new. You'll see them from the final truth in lending that we had the borrower sign at closing before. There are total payments, finance charges, amount financed, and annual percentage rate. We once again have that total interest percentage field that the CFPB added, and we talked about that briefly on our loan estimate. The calculations are still the same in the way that's calculated. The total interest collected over the life of the loan divided by your loan amount. So we see here our example 69.46%. That's rather large percent, and I think again it's going to be one of those fields that generates some of the most questions from our borrowers. On the right side we have other disclosures. The CFPB thought the form should have some more statements. We have an appraisal statement as well as information about contract details. The liability after foreclosure statement indicates whether state law may or may not protect the borrower from liability for unpaid balances in the event the loan is foreclosed upon. And then we have statements regarding refinance of the loan and tax deductions that the borrower may get for taking out this mortgage. Next, we have the contact information section. This section should reflect the names and phone numbers of everyone associated with this loan. It will reflect lender and mortgage broker information, if you have a mortgage broker, as well as loan officer information. Also reflected are the names and contact information for all real estate brokers and settlement agents that might be involved. This information is provided so that the borrower can reach out and contact the appropriate party if they have any questions after reviewing the documents. Remember, the borrower must receive the closing disclosure 3 business days prior to consummation, so they'll have plenty of time to get any questions together and contact the appropriate party for answers. And at the very bottom, again, we have a confirmation statement that the borrower can sign confirming receipt of the closing disclosure. I'm now going to turn it back over to Steve so he can talk about a few of our key definitions. Just like with our loan estimate, there are a few permitted alterations for transactions without a seller. Here we're looking at page 2 of our closing disclosure. You'll note that the seller column that we saw before is now removed for a transaction without a seller. Next, we're looking at our cost at closing table. Just like with the loan estimate, it can be replaced with an alternate version for transactions without a seller. And just like on the loan estimate, if you use the alternate tables on the loan estimate, you must also use them on the closing disclosure. So we had the cost at closing table as well as our calculating cash to close table that we're going to look at on the next slide. If they were used on the loan estimate, then they are required to be used on the closing disclosure. And here is that calculating cash to close table that I was just talking about. At the very bottom is the alternate version that would be used for transactions without a seller if the cash to close alternate table is used. Another permitted alteration for transactions without a seller is the page 3 summaries of transaction table. It can actually be replaced with a payoffs and payments table. And this table basically would list all of the payoffs associated with the loan, whether they're related to the property liens themselves or other credit transactions that are required to be paid off on the loan. This particular slide isn't related to transactions without a seller. If you'll remember, we talked about on the loan estimate the adjustable payment table and adjustable interest rate table. I just wanted to show you on this page where they would show up on the closing disclosure if they applied. Remember, these tables only show up if they have features that are related to these tables. So I'm going to turn it back over to Steve here, and he is going to cover a few of our basic definitions that we talked about earlier.
Thank you, Georgette. There are two different definitions of business day that pertain to the loan estimate. Thankfully, these two definitions are the same two TILA currently uses and are defined in the Mortgage Disclosure Improvement Act. The loan estimate must be provided to the borrower within 3 business days of application. Business day in this scenario is defined as a day on which the creditor's offices are open to the public for carrying out substantially all of its business functions. This is the same timing requirement that the initial TIL has. And here, provided means delivered to the consumer or placed in the mail. The loan estimate must be provided to the borrower 7 business days prior to consummation of the loan. Business day in this scenario is defined as any calendar day except Sundays and legal public holidays. This includes Saturday. And again, this is the same timing requirement that the initial TIL has currently. The 7-day waiting period begins when the creditor delivers the loan estimate or places it in the mail, not when the consumer receives it or is considered to have received it. The next timing requirement is brand new and will certainly take some time to get used to. The closing disclosure must be provided to the borrower 3 business days prior to consummation. Here, business day is any calendar day except Sundays and legal public holidays. If the closing disclosure is not accurate, a corrected closing disclosure can be given to the consumer on the day of closing. However, if the change relates to an APR change of more than 0.125%, or the addition of a prepayment penalty, or a change to the loan product itself, such as going from a fixed rate to an adjustable rate, then a new closing disclosure must be issued and a new 3 business day waiting period must elapse. Also, I'd like to point out that these timing requirements can be waived, just like today, for consumers with bona fide financial emergencies. However, this is generally not a great idea for the lender, as the secondary market does not look favorably on these exceptions, and it is likely a loan with a bona fide financial emergency will not be saleable. Here's a quick example of the loan estimate timing. The application is received by the creditor on Monday. 3 business days elapse, and the loan estimate must be delivered or placed in the mail on Thursday. This is fairly straightforward, just like how we do things today with the initial disclosures. The 3-day period begins when the creditor delivers the closing disclosure or places it in the mail, not when the consumer receives it or is considered to have received it. If mailed, it is considered to be received 3 business days after placing it in the mail. Here is another example of the 3-day waiting requirement for the closing disclosure. The closing disclosure is received by the borrower on Monday. The earliest the closing can occur is on Thursday. Now on to another important definition. What is an application? Receipt of these 6 pieces of information constitutes an application: the borrower's name, borrower's monthly income, the borrower's social security number, the property address, the estimated property value, and the estimated mortgage loan amount. You'll notice that the 7th category, which was a sort of catch-all, has been removed to make the definition of application more precise. The lender can still ask for additional information, but if this information is not given, then it must still be treated as a completed application, and the 3-day clock will start to tick. What is consummation? The new rules reference consummation, not closing throughout. So what exactly does that mean? Consummation is when the consumer becomes contractually obligated on a credit transaction. In most states, this is the point at which the consumer signs the note, and in Texas, this occurs at closing. Who will provide the closing disclosure? Today, the settlement agent prepares the HUD-1 settlement statement and provides it to the consumer after lender approval. With the implementation of the new closing disclosure, lenders will need to determine exactly how they are going to coordinate this with the title company. The lender will have to ask important questions. Will they still allow the settlement agent to prepare the closing disclosure, or will the lender now prepare its own closing disclosure to provide to the consumer? Because the lender is ultimately responsible for the contents of the closing disclosure, it appears that it is in the lender's best interest to complete and deliver the closing disclosure. Based on industry discussions, it appears that most lenders will prepare and deliver the closing disclosure to the consumer. Now, I'm going to turn it back to Georgette, who will discuss how the fee tolerances have changed based on the new rules and disclosures.
Thanks, Steve. Let's move on and talk about everybody's favorite, cures. The CFPB has decided, let's just rename them. They refer to them as variance cures. So as you're closing loans, you may still hear the old terminology, tolerance cures, you may hear variance cures. But either way, I know not many people like to pay out cures. We still have the same categories that we had before. We have our 0% fees that there's no change permitted in the fees that were disclosed. We have our 10% cumulative, and then the unlimited category are fees that there's no limitation on the amount that they can change. That's the first one we're going to talk about here. This category really hasn't changed in the fees that are reflected in this category. We have our prepaid interest, property insurance premiums, escrow type reserve fees. And then we have the third-party service fees that the lender provided a provider list, a service provider list to the borrower, but the borrower chose someone not on that list. I know most people refer to that as borrower chosen in the past. Those fees still go in this category. And then any charges paid to a third-party service provider for services that were not required by the lender. So if the borrower decided to have an inspection done that was not required by the creditor, then this is the category that that fee would go in. The next category we're going to talk about are the fees with the 10% cumulative variance limitations. Again, there's not many changes with this particular category. We still have our recording fees, and then we go back to those third-party fees where the lender gave the borrower the service provider list, but this time the borrower chose the provider that was on that list. Those fees were previously reflected in the 10% cumulative category, and that's where those fees are going to stay. And last but not least, we're going to move into everyone's favorite, the 0% variance category. We have any fee that's paid to a creditor, mortgage broker, or an affiliate of either one. We have fees paid to an unaffiliated third party that the consumer is not permitted to shop for, and transfer taxes. Some of those we saw before, but let's go back and talk about the first two. Any fee paid to a creditor, mortgage broker, or an affiliate of either one. We actually have some clients who have affiliate title companies that they use. Previously, title fees would have either been in the 10% category or the unlimited category. Now, if the affiliate title company is used for the closing, those fees will now be reflected in the 0% category. The same thing with any fee paid to an unaffiliated third party. These are going to be fees such as your appraisal fee, your credit report fees, and your upfront mortgage insurance premiums. Previously, these were in the 10% category, so if you underestimated your cost just slightly, you generally had that cushion in your 10% category to absorb those extra costs. That won't be the case anymore. So it's going to be really important as we move towards August 1st that communication between the loan officers, the lenders, and some of these outside third-party services become very important so that they can start to pin down amounts related to these services, and they can be disclosed accurately on the loan estimate. And hopefully as we move out past the August 1st date, this will become a little bit smoother and everyone will have this down better and there won't be as many cures reflected. But I think starting out, this is the category that may generate the most cures and issues as we move forward. I'm going to turn it back over to Steve so we can finish up our presentation. I appreciate your time this afternoon.
Finally, here are some key ideas to think about moving forward. Who will prepare the closing disclosure? As I stated earlier, it appears that most lenders intend to generate and deliver the closing disclosure themselves. Both Wells Fargo and Bank of America have already announced that they intend to prepare and deliver the closing disclosure, and it looks like most lenders are following suit. Lenders need to determine how they will generate the closing disclosure, as well as how information will flow to and from the title company. Communication between the title company and the lender is going to be increasingly important. Timing issues. Most of the disclosure timing requirements remain the same. However, the fact that the closing disclosure now has to be in the consumer's hands 3 business days before consummation will certainly affect the flow of the transaction and does represent a big difference from the current methodology. Employee training. Employees will need to be trained on the new forms and understand them inside and out. Loan officers will need to be able to explain the nuances of the forms to consumers and, unfortunately, need to prepare for the inevitable question about total interest payment that Georgette mentioned before. System updates. Software will need to be completely overhauled to use the new dynamic forms, which will be very time-intensive and costly. Closings will take longer. Now that there are more pages to go over, the 5-page closing disclosure instead of the 3-page HUD-1, and the fact that the consumer now has more time to review the closing disclosure, we think closings are, on average, going to take longer. This means fewer closings in a day for title companies, which means less revenue. This may lead to higher charges from the title company. Additionally, the new forms represent a change in philosophy, going from bundling of fees to unbundling and itemizing fees. Because of this, we will likely see more questions related to fees. A change for the better. Overall, we feel that this is a change for the better. The CFPB did a pretty good job with the new forms. They're pretty well laid out, they're easier to read, and they do cut down on some of the overlapping information. Consumers should understand the information if they do take the time to read the forms closely. Only a few short months left. Failure to comply with the new disclosure rules can lead to a $4,000 penalty, plus actual damages, plus attorney's fees. So it's really important to understand these rules, familiarize yourself with these forms, and get it right come August. This concludes our presentation. We thank you for listening. Below you can see some contact info here. We also ask that you please keep an eye out for future presentations that will take a more in-depth look at both the loan estimate and the closing disclosure. Look for these in the next few weeks. Thank you.